Good morning, and thank you for joining us today. We have the CEO and Managing Director of Metro Mining, Mr. Simon Wensley, and the CFO, Nathan Quinley, here to discuss the June quarterly report and present an overview of the quarter past and an outlook to the quarter ahead. I'm going to hand it over now to Simon, and there'll be questions at the end. Thank you.
Thanks, Peter. Good morning, everybody. Look, we've had one overwhelming objective Q2 this year, and that was to implement the expansion to 7 million tonnes. We had obviously been layering some of the smaller aspects of that through the back half of last year, but this year with the Ikamba floating terminal Ikamba coming in and our new screening circuit, that was the bulk of the capital, and also then I guess the bulk of the changes that we were going to make to ramp up to 7 million tonnes. So look, I can say that's been achieved. We've got both of those pieces of equipment up and running and working, commissioned and ramping up. So look, commissioning, an expansion is always fraught with issues. We had some bumps in the road with respect to that commissioning, but overall, I'm very happy with the fact that we've managed to get everything in and running. Those bumps in the road have caused, a delay in the ramp up. That's probably of the order of 4 or 5 weeks, but that's been frustrating for a number of reasons. But look, when I stand back and I look at that, and I now see the profile of our ramp up, it is basically as we had planned, only effectively a month or 5 weeks late. So look, that for me was the overwhelming objective. That's what we've achieved, and I'm very happy. And I think tribute to all of the team, given the circumstances, some very wet weather running through into April and May, some issues that caused issues, particularly with the wobbler circuit ramp up. And then look, unfortunately, we also had a minor breakdown in the barge loader. A long story, but look, it shouldn't have happened. And we're going to take that on board as a learning experience and make sure that it doesn't happen again. So anyway, look, that's where we stand in that context. Having a record Q2 production throughput was pleasing, even in those circumstances, albeit a bit behind plan where we wanted to be. I guess the other part of it was the other side of it from a market perspective, positive, very positive, signs and from the market in terms of continuing strength, and the pricing is continuing to improve, and I think that's still happening and continuing to happen through the next quarter for sure, in terms of the pricing negotiations that we're seeing. And I'll spend a little bit of time talking about the market today, maybe a bit more than normal because of some of those trends that we're seeing. The placement, we took an opportunity to raise some money in the equity markets through a placement and SPP in May, and that was really directly around trying to pay down our junior debt early. So we had about $39 million of junior debt. We've made the first tranche payment on that already, and we are due to pay the last tranche for that in the coming month or so. So there is and that's obviously subject to covenants with our senior lender, but we expect to be able to meet those and make those payments. So look, I think that's where we're at in terms of looking forward. We've trimmed the guidance by about 5% down to reflect the delays that we've seen. But as I said earlier, from that perspective, the ramp up is going well, and we aim to be back at plan, and we're actually in that zone. We're in the zone we wanted to be now already, and have been over the last couple of weeks. Look, I might bring up the quarterly, and then we can talk through the various elements there. Okay, hope everybody can see that. I mean, the front page obviously is a summary. Yeah, so look, I think, you know, we welcomed Ikamba in the to the site. It arrived at the back end of April and was already operating at that point, and we then conducted a welcome ceremony. Ikamba is obviously a significant name. It's the Ankamuthi word for saltwater crocodile, and we had a very good representation of our partner groups, the traditional owners of the land on which we operate, to come and welcome Ikamba onto the waters and into the country. So that we hope is a good luck, good omen for moving forward. The new screening circuit was also commissioned, as I said, in mid-May. That sort of slowly ramped up from mid-May through to June, and we've been now seeing regularly the 1,500 ton per hour target capacity. We've retained one of our vibrating screens, one of the previous screens in plant one, so that gives us a total capacity of around 2,250 tons per hour, which is in excess of the BLF, which has a peak loading capacity of about 1,900 to 2,000 tons per hour. So that does give us a bit of operational flexibility with the high capacity, the ability to stockpile pre-screened ore, etc., and give us some sprint capacity if we need it. Look, you can, when it comes to a flow sheet, obviously the individual elements are important, and we've been obviously focusing on implementing all of those individual elements right the way through, from additional mining fleet, haulage fleet, the screening side of things, the barge loading, tugs, barges, and transshipping. So it's a relatively, it's about a 5 or 6 step flow sheet and a value chain, and all of those elements, have been we focus on all of those individually, and individually now they've all demonstrated at least the target capacity, which we've been looking at around 7.5 million tons per annum equivalent, or that's around sort of that, 29 to 30,000 ton per day. They've all demonstrated at least 30,000 tons per day capacity individually, but it's all about now integrating those aspects. And so you have the natural variability of a mining process, and then with a new production process, it's all about trying to reduce the variability in each one of those. And so that is the task that now faces us as we try to integrate all of those things. We've put in place a number of integrated planning processes to be able to do that, working with our transshipping partners and our maintenance partners, to be able to try to drive that increase in output. And so there's a whole bunch of I guess technology and planning that goes into that, and that's sort of starting to come through at the moment. And you can see, what we're trying to do here at the end of the day is get between 5 and 6 barges per day out through the tidally constrained bar that we have at the end of the Skardon River. If we do that, then we will be able to deliver, that 7.5 million ton instantaneous rate. And so that is effectively the target. Obviously, what's on the barge is important, and so the upstream elements, the mining and the screening, have to do their jobs to be able to make sure that what's called for on each barge from a draft perspective is loaded on that barge, and that's also evolving now in terms of strict time targets for each barge, and then that's being done in order to optimize the cycle time of the tug and barges out to the anchorages and back. So we're currently running, as you can see, there's a lovely picture here of the 2 transshippers working on a Cape-sized vessel. So you can see Ikamba there in the front of the picture on the left-hand side, and TSA Skardon, the single floating crane, sitting back towards the stern of the vessel there. And so, you know, optimizing those two transshippers is also important, and you know, understanding which barge goes to which, and that is also now evolving with the help of some new software that we're putting in as of this month. So look, that's work in progress. We're already running at about that 6.5 million ton rate as we speak. I'll talk a bit more about the ramp up in a second, but let's talk a bit about the market. Look, I might just mention, so in terms of budget, we came out, I think, in the third quarter last year with a slightly revised capital budget, so 36.1 million. So as of now, as I said, we are effectively 100% mechanically complete on the expansion. About 90% of that capital has actually been spent as of the end of the quarter, and we expect to come in at or slightly under that approved budget by the time we finish. So we've got obviously very good visibility of that, and the rest of that will be spent in quarter three. So the bauxite market, look, there was a record. We talked about this in previous webinars, that there was a record traded market in Asia Pacific last year. Proxy for that is China's imports. That's the major market in Asia Pacific, and so we saw a 13% year-on-year growth last year. We're already tracking now this year at about a further 7% plus growth. There's about 77 million tons of imports into China year to date. So again, a very strong growth profile for traded bauxite. And so you can see that occurring here. You've got the total demand covered by domestic and by imports in China, and you can see that overall demand, you know, the trend is still growing there, and with some seasonality, of course, but domestic bauxite is still continuing to drop, and that gap is being filled by the traded bauxite. So as I've mentioned in the past, it's quite a similar story to what occurred in the iron ore market back in the early 2000s, when steel production was growing in China, but China's domestic iron ore production was declining. So that's what created that strong growth, and that's why we're seeing, you know, prices the way we are. And that's sort of flowing through to the alumina price. Obviously, our customers are producing alumina, and after a relatively flat 2023, we've seen significant sort of growth in the alumina price from the beginning of 2024. And of course, you know, that's important for our customers to be able to place their tonnage, and it also allows them, of course, to pay more for bauxite, which of course is encouraging. So look, there's one graph I haven't used before, which I think is very interesting. And again, this is a proxy. Here's the domestic Chinese bauxite pricing, and you can see here, you know, from around about the sort of 325 RMB per ton, you know, from, you know, the back end of 2020, 21, you've seen this growth in bauxite pricing right the way through the period, and indeed, you know, over the last 6 months, 6 to 9 months, an even stronger growth than we've seen in that previous sort of couple of years. And so indicatively, you know, it doesn't really matter where the bauxite's coming from. Predominantly, it comes from 3 provinces in China that you can see there. But that's obviously also a driving force for imported bauxite demand and also imported bauxite price. And so you can see why that's occurring, and that's indicative of I guess the restriction in supply coming from the Chinese mines. So look, what does that mean in terms of bauxite price? Well, look, here's the market index that we use. This is the delivered pricing for Guinea and Australian bauxite as described by the CM Group. And, you know, you can see that we've seen this growth over the last sort of 2.5 years. So mirrored in the record import demand, you can see that price moving up. And it's also indicative of costs and cost of production for both Guinea and indeed some inflation in Australia going the same way. But again, you can see, we've talked in the past about this gap between Guinea and Australia, and now you can see, sort of was roughly about sort of 20, $15 to $20 a ton. That has closed, which is defined by the value in use. So people are seeing value in the Australian bauxite. Normally that one might be $8 to $10, and you can see that gap has closed, particularly over the last 6 months. So we've seen, prices rise certainly in the last sort of 6 months from around that $50 to around almost $60 per ton, delivered into China for this benchmark product. So Metro prices will follow that same trend. This is predominantly the Australian prices, predominantly the Rio Tinto volume, who have a much larger volume into the market. We tend to follow that same trend, although it will take probably a couple of months, 2 to say 4 months, for that lag to flow through to our contract pricing. And so we're already seeing that. And I've mentioned, we're looking like we're going to get another roughly sort of 8% or so rise in our FOB equivalent for this current quarter, which reflects sort of that trend there. So look, very, very positive sort of outlook, and we're seeing both the Guinea price and now importantly the Australian price starting to catch up. I'll just talk a bit about this we've used this chart a few times, and you can see here that we've had quite a volatile sort of commissioning period. That as I said earlier, has been a little bit frustrating, bit of combination of weather through here, late delivery of the wobbler system, about 4 to 6 weeks late there. And so, it's been a bit of a frustrating time. Also we could have done more tons in this last quarter for sure, but that hasn't been the focus. The focus has been on commissioning and implementation. We've stopped the plant when we've needed to make an adjustment or to make an improvement or to fit a piece of equipment or whatever that needed to be fitted or optimized. So look, we haven't been chasing the tons in this last quarter by any means, but the critical part was getting all of that system working together. So we're now in the zone. You can see we're sort of getting up to that zone. We've had a pretty good last sort of week or so as after we've recovered. We had a weather event at the end of last week for a couple of days. So we're now back up, into that zone, demonstrating a step up again into this sort of 6.5 to 7.5 million ton zone. So that's where we're now going to be pushing through. For example, the last 24 hours we did, over 29,000 tons, which is heading towards that 7.5 million ton rate. So look, if I stand back and look at that trend, despite the dips there, it's the trend that I wanted to see. I should have been maybe a month earlier than what it was, but we are on that implementation trend, and we're in the zone. What we will see moving forward as we start to bed this down and get the coordination between all those elements of the value chain and the flow sheet, we are also going to see, as you've seen to some extent in 22 and some extent and a greater extent in 23, we get a natural benefit as well from tides, weather, and the moisture in the ore obviously is dropping as the dry season sort of continues to work its way through until we get to December. So that'll helps productivity. It reduces the variability in the system and enables us to sort of be confident that I think that we're going to quickly get into the zone there in terms of getting to that output. Look, I think just wanted to touch on safety. We've been introducing a lot of training into the site, and of course with our new marine team coming on as well, we've been trying to bring that same culture to them. It's pleasing to to have had an improved record here. Still had one lost time injury, although it wasn't classified as a serious accident. So, we're still getting a few high potentials. That means we're getting things that could have caused an injury, but we're quite effectively like near misses that we're then working that through into our critical risk register to be able to try and engineer out those conditions and those situations. So obviously systems and processes allied with culture is where we're trying to mature this. And we're certainly seeing some good signs in that sort of safety, and sort of hats off to the operating teams there and the safety teams on site for driving that forward. Maybe I'll come back to the equity and balance sheet. I'll get Nathan to cover that in a second. So where's the cost? So here. So look, without trying to dodge the bullet here, obviously costs have taken an impact, operating costs. So we're on budget for the capital, but there are some one-off costs that we've had to incur for the commissioning. Probably about $3 to $4 a ton of that is probably one-off costs, and the rest of it is to do with the economies of scale. So we did bulk up our fixed costs ready for the 7 million ton rate. We didn't make that in the quarter to that extent. So that obviously then affects the total cost there. So a disappointing cost outcome, but one that was probably expected given the lower tons and the delay that we've had. But as I said, look, we're still shooting for that $15 a ton margin in the second half, and I think that's eminently achievable, given the rates that we're seeing now and the rates that we're seeing, with the expectation we've got in terms of the ramp up. So we're seeing all of that come together to be able to hit the we need to sort of deliver that sort of now new 6 to 6.4 million ton guidance range. Look, I might pause there. Nathan, did you want to make a quick comment on the balance sheet and the?
Yeah, sure thing. Thanks, Simon. So what we've included in here, and we'll do for the next couple of quarters, is just the use of funds table following the capital raise that Simon mentioned earlier. So obviously the purpose of that capital raise was around the repayment of the junior debt. We have at this point paid that first tranche of $17 million, and we expect to make that second tranche of $22 million in the next month or so. Look, just in terms of working capital, just by a function of balance sheet end date and closing cash position, we've used an extra $15 million in working capital. But if you turn your eye to the combined cash and trade receivables position of $32 million, you can see that essentially that additional working capital, or that working capital difference, is sitting in trade receivables at the moment, and has otherwise since been recovered. So in combination of cash and trade receivables, where we have reasonable expectation of being able to complete that junior debt repayment in the next couple of months.
Okay, Peter, I'm happy to take some questions if there are any.
Thanks, Simon. Yes, we've got a good audience here and some good questions coming through. Some of those questions which you will have answered, but we'll highlight them here. The first one I'd like to relay is, what kind of pricing range can we expect for Q3? What's the mix between offtake and spot?
Okay, well, in terms of the pricing, it's all effectively contracted. We have had a couple of spot cargoes this year. Sorry, there'll be one spot cargo in this quarter, but almost all of it will be contracted. But as I said, we're having those conversations now. My expectation is that before we have before demurrage or any one-off issues like penalties or anything else, then we should see about an 8% rise in the FOB sort of price for those contracts that are being negotiated this quarter. Of course, there is some fixed price volume, which is a part of what we call the expansion contracts that we took out in 2022 when we launched the expansion DFS. So we did 3 million tons of expansion volume contracts there. They were fixed price at the time in order for us to be able to get lenders over the line as to the forecast pricing. And so we've already sold 1 million tons of that last year. There'll be 1 million tons of sale of that this year, and then another 1 million tons of those fixed price contracts next year.
And segueing to this question, do you expect to sign additional offtakes this quarter?
Yes, I do. We're working on. We don't have the sales profile in this one, but if you look at the most recent Noosa presentation, you'll see the offtake position. That hasn't changed much in the last sort of 6 months. We are in negotiation with 2 parties at the moment on, Laura might call, one is with an extension deal and one on a new contract that would go out maybe 2 to 3 years. So we're in the middle of those negotiations. I'm hoping that we might be able to sign those in this current quarter, but if it's not this current quarter, it'll be pretty soon into the fourth quarter. So we're looking to try to have a bit more spot volume available in this strong market. Part of the reason why these prices the Australian prices have gone up is that there's been an increase in the spot availability from the Rio Tinto portfolio because of a force majeure event at their refineries in Gladstone. So there's been a few more cargoes available to the Rio team, and they've been out there, selling those in a way that has provided a lot more price transparency as to the strength of the market. So we're benefiting from that, obviously, and we're hoping in the future. Certainly, my plan is to have a greater proportion of spot cargoes every quarter from next year onwards.
Thank you. You did discuss this, but I'd like to relay this question. The site costs showed an increase of 22% to $31.80 per tonne from the second quarter. Is this cost rate expected to continue, or can you advise what the level you seek it to revert to?
Yeah, so like I said, Nathan, add anything after if you like. But I mean, there's about $3 or $4 there of what you might call one-off fixed costs that we've put in place. Things that we've had to do to get the commissioning up and running and so on. So that obviously won't exist as we move forward. And then the rest of it is all about economies of scale. So only doing 1.4 in the quarter, albeit it was a record second quarter. But we had bulked up our costs, workforce, equipment, consumables, spares, etc., to be able to run at that sort of roughly that 7 million ton rate by the end of the quarter, which we didn't achieve. So once we hit that stride, and we are now in that, as I said, in the zone of hitting that stride over the next week or two, then that we expect to see those costs come down significantly to be able to generate the margin that we've been talking about. So look, we've been targeting sort of $20 to sub $20 costs, and that's certainly still where we're targeting the cost number to be once we hit that run rate.
Yeah, that's right. And I just add there as to what Simon has said is naturally there was some non-recurring costs or friction costs that have occurred as part of executing the expansion. But otherwise, what you're seeing, given the production level, is not surprising, given the high operating leverage of the business. That high operating leverage is exactly why we're shooting for the $15 per tonne, which we still have reasonable expectation of being able to accomplish once we're bedded in these higher run rates. So it just shows you the sensitivity around production and just that high fixed cost component as well. Having said that, once we've looked through the quarter, pleasingly, there's nothing within the cost structure that hasn't been consistent with our expectations. So the, like anything as part of the commissioning, we've got new assets that have come in, and from a cost structure perspective, we're seeing exactly what we expected to see there. So there hasn't been any nasty surprises that would give us a sense of cost escalation that needs to be accounted for further through the period.
And therefore, Nathan, the following question is about capital expenditure for the second half of the year. What are your expectations?
Yeah, like Simon mentioned, from a I guess project delivery perspective, we're done. We're 100% project delivered. From a CapEx spend perspective, we are at about 90%. That remaining 10% is essentially scheduled milestone payments that will be made in this current quarter. So what I would expect that everyone will be able to see come into the Q3 quarter will be somewhere around that $3 million mark for the remaining project expenditure.
And a few questions here around freight costs. Compared to quarter 2 23, CIF pricing was $10 a tonne, but FOB pricing more or less the same. So freight is up, despite moving to Cape-size vessels. Can you discuss the dynamics around the freight market environment now, demurrage, and where you expect that to be going forward?
Yeah. Look, we're largely contracted this year, so our freight costs are largely fixed and known for this year. So there is one of the contracts has a bit of a fuel adjustment in it, so the freight rates will be very slightly higher because of that. But the main reason why those things are different are because of, look, we have to effectively start our freight process about 30 days in advance from when the ship arrives, and it gets locked in probably, I don't know, fully locked in about 22, 23 days before. So from our perspective, we need to be looking forward always, roughly 30 odd days to be able to say, well, what do we think the production rate's going to be? Now, as I said, we've had a couple of bumps in the road here, particularly that barge loader breakdown and the weather events that we've had at the beginning of July, for example. These are sort of unpredictable things that will affect the loading rate and therefore the speed in which we can load these vessels. So unfortunately, what that means is when we have those events, we get demurrage, and so that there's a significant chunk of demurrage in that difference between the CIF and the FOB price. So a couple of dollars on that. The other aspect, which is, I'll just touch on, but it's sort of again an unknown, I suppose, in terms of bedding down a higher, we're running almost now double the rates that we're running 12 months ago. Is that we've seen some issues with our belt analyzer in being able to see what the actual grades of the we do a real-time grade analysis, so we've got 4 checkpoints on grade, the grade control, we've got a belt analyzer, we've got samples that we take and we measure those. We can measure those both at site and in a laboratory. But because we're loading vessels faster, we're now not getting the actual analysis back from the labs until the vessel has sailed. So this is the sort of delay. So we're having to modify that, and we've had a couple of penalties on our, nothing major, but penalties that where our specification has moved away from the target specification in the contract. So that issue is solved, but it's one of those things that you really, it was an unexpected issue to occur once the volumes across the belt were moving. We got twice the volume, twice the speed. The belt analyzer was not was not picking up the grades as we had mentioned. So these are some of the things that affect that difference between this CIF and the FOB, and very little of it is to do with the freight rate itself. It's more to do with the demurrage and other things.
Thanks. So just a couple more. Assuming smoother quarter of operations, I know we've covered that one. A time frame for turnaround of the ships in the queue is 7 to 8 days realistic?
Yeah, absolutely. We've now moved all of our freight contracts to a loading rate of 25,000 ton per day as a minimum. So we were confident enough to do that at the start of July. So that's now in place. And look, if you do the math, that's roughly 7 days for a Cape size of 175,000 tons. So that's the minimum rate that's now sitting in the contracts, and we expect to try and beat that. We're obviously looking at that, high 20s to 30,000 tons per day. So ideally, what we're looking at is roughly around a 6 day turnaround. Now, that's if they were sort of like back to back. And as you can see, if those people who are following the the shipping and the barging that's occurring, at the moment, how we're operating is we're actually overlapping vessel loading. So one of our transshippers will accompany a vessel to the offshore anchorage, and the second transshipper will start on the next vessel. So at the moment, we're purposely not aiming for that 6 to 7 days per vessel. It'll be a bit longer than that, but I guess what we're looking at is that overall loading rate between both transshippers on those vessels. So again, as I said, that will probably mean that an individual vessel may take 7 to 8 days, but the overarching sort of average between vessels should be in that 6 to 7 days.
And we'll finish off with a question here about the weather, which is important up there in that part of the country. How many wet days do you budget for, and how many have you used so far in 2024?
Gosh, that's a good question. We budget about 25 in a 9-month period. We budget about 25 wet days, so that's about 10%. We look at empirical data for it. We mainly look at wind and wave data. So that is the critical issue for us, and that's mainly obviously due to the transshipping. So we've looked back at wind and wave data both for Skardon River, but also we look at the Weipa area and also up in the northern peninsular areas. So we look at that data, and empirically that suggests that is the amount we should be budgeting for. And obviously it's skewed. April and May and December will have more of those days, and the middle of the year will have less of those days. Now, in June, we had very little weather stoppage, and so we've almost used up none of that. We would have budgeted probably 2 days in June. We budget about 1 to 2 days from July onwards to the end of October, and then it starts to get a bit more. So how much have we actually used? I mean, it's sort of it's sort of not the right question. I mean, weather is a random event, and I suppose we've probably used. It's not like if we have more weather in June, that it's likely to be less weather in July. That's not how it works. So it is what it is, and it's a random event. Last year we had more because of the cyclone. We had more weather days than average or normal or suggested. I think this year we're probably tracking a bit over because of the wet and difficult April. But Nathan, I don't know whether you've done the sums on that.
No, thanks, Simon. Yeah, so aside from that slightly wetter April, I think at the moment what we're seeing is that we're tracking broadly along with the 5-year average of empirical data. As Simon said, unfortunately, worse weather now doesn't mean less weather sort of in the future, but from what we're seeing so far, it looks like it looks broadly in line with empirical data.
All right, good. Well, sunny weather in North Queensland means pretty solid loading schedule, which is great. Simon, Nathan, thanks very much. Simon, anything for investors? We've got a good number here in the call just for the coming months.
No, look, I mean, thank every shareholder for their support. This has been a journey. We were doing 2 million tons when I joined the company the middle of 2021. You know, we're on a pathway to over 6, you know, this year. I mean, that's a triple where we were from that period. I think, you know, we've obviously had to restructure the company, both from a financial point of view, a balance sheet, you know, point of view, and also from an operational point of view. So there's been a lot of work done to create a much more resilient and a much more, you know, robust company. We did a lot of work on freight, reduced the risk out of the freight side, for example, which was, you know, almost sent the company bust in that period of 2021. So that isn't going to happen again. You know, certainly not under my watch. So look, I think if we take that view, we're on the cusp here. All of that is implemented, and we're now in an execution phase. So we've got, you know, 6 months to ramp this thing up and get to that 7+ million ton rate. And I think, you know, I'm very confident with that. With that, the team on site are very motivated, and we're all actually quite excited that we've got that in place. And I think that was, as I said, the overriding target for last quarter was getting this expansion in place. And so it wasn't about maximizing tons. That's obviously part of the financial equation, but you know, it was all about setting ourselves up for the future. And so this expansion, this equipment, this will see us, you know, this is the next 5 to 10 years of Metro that we've just effectively put in place here. So look, markets are with us, prices are strong, we're heading down the cost curve. We will be once we get up to that rate. And so look, I think from a margin perspective, you know, we're right on the cusp of a transformational sort of event here. So look, thanks for everyone's support. You know, it's a good time. It's a good time to be in Metro, and I think, you know, this coming quarter and the last quarter of the year will be, you know, a transformational sort of position for us.
Thank you, Simon. Thank you, Nathan. And thanks for everybody who's joined us here today. We look forward to the next update from Metro Mining.
Great. Thanks, everybody.
Thanks, everybody.